Hi, my name is Gary Mishuris. I'm the Managing Partner and Chief Investment Officer of Silver Ring Value Partners. Previously, we talked about the idea generation process, which is how do you come up with potential ideas to investigate further as potential investments. This time, we're going to talk about the next phase, which is what do you do when you find an idea? How do you actually research it to determine whether it's a good investment or not? And the way I approach it is via what I call the 5-step research process. And the 5 steps are company quality assessment is the first step. The second step is analysis of key economic variables. The third step is financial modeling. The fourth step is evaluation. And finally, the fifth step is behavioral checklist. So I'm going to go through each step and explain what it means and how to put it all together to determine if some company that I'm looking at is a good investment. So let's start on step 1. So step 1 is company quality assessment. There's 3 things that I think comprise quality of a company. The first is the business. How good of a business is it? The second is it's really management. Is it well managed? And we'll talk about what that means. And finally, it's the balance sheet. Can it withstand temporary adversity? Those are the 3 things. So it's the business, it's the management, and it's the balance sheet. And altogether, those 3 things contribute to the quality of the company. So let's talk about the business. Think about it as a ship in a river. So you have the body of water, that the ship is traversing, whether it's a river or a lake, and that's the industry. That's the environment. And there are some very turbulent bodies of water, and there are some very calm ones. And so same with industries. There are industries which are structurally attractive, where the Porter 5 Forces analysis suggests that most companies would do well and have high returns on capital. And there are industries where the economics are challenging, and it's very hard, if not impossible, to have good returns on capital over time. So it's very important to do a Porter 5 Forces analysis to understand the quality of the industry. The second part of analyzing the business quality is understanding a company's sustainable competitive advantage. So let me say it again, sustainable competitive advantage, because that's really a very, very important aspect. I think it's one of the things that Warren Buffett always focuses on, and rightly so. And here what we mean is, what is this company doing that allows it to earn excess returns on capital that others cannot quickly replicate? It could be a low-cost position. Let's say you have a much higher scale, and therefore your cost of making each item is much lower than the competitors, and therefore you can charge less, and they can't replicate that because you already have that scale, and they can't catch up. So that could be an example. Another example could be differentiation. Maybe you have a unique service offering, a reputation. Let's say you're McKinsey, and let's say Gary Mishuris decides to start a consulting company to compete with McKinsey. Chances are McKinsey's clients are not going to switch because McKinsey already has their reputation, and it's going to be very hard to catch up for some new entrant. So low cost is one, differentiation is another. A recent one that's been very important to some companies, economies of network. So we have all these platform companies such as Facebook, and there it's it's a market where you have buyers and sellers. Another example would be an Uber or a Lyft. And once you have a marketplace with the most buyers and sellers, it's very hard for an alternative marketplace to compete because people don't want to post, let's say, their life updates on multiple social networks. They just do it on Facebook. And therefore, it just creates this virtuous cycle where it becomes essentially a monopoly in that space. So that's a third, so economies of network. So you want to look for the presence and magnitude of a sustainable competitive advantage, and you want to understand the quality of the industry and whether it's attractive from a Porter 5 Forces analysis perspective. And altogether, that gives you a sense of how good of a business it is. And by the way, it is a range, so it's not that it's good or bad. That's not the right way to think about it. It's really a continuum from terrible to excellent, and most companies are somewhere in the middle. And you want to understand where on that continuum a given company is positioned. So let's talk about the second aspect of company quality, which is management. So management is really important because at the end of the day, if you're a long-term investor, the management of a company is going to impact your economics quite a bit. And there are two things you want with management. So the first one is competence, and the second one is alignment of interests. So let's talk about competence first. So by competence, I mean there's 2 dimensions to competence. One is operating the business. So can this team operate the business quite well? The second is, can they allocate capital well? By allocate capital, the company generates free cash flow. That's a key characteristic that we look for in a business. What is this management team going to do? Is it going to pursue empire-growing acquisitions just to get a bigger comp package because a consultant will give them higher pay because they're now running a larger business? Or are they going to think like owners and try to maximize intrinsic value per share via their capital allocation program? It's the latter that you want. And the way you assess competence is you want to look at their track record. You want to look at not just what they're saying, but what they've done over time. Has the business done better than its peers in terms of key operating metrics? Has it done well on an absolute basis? Has the management added value per share or destroyed value per share through their past capital allocation decisions? So all of these are inputs in determining the competence of the management team. Next, you want to look at alignment of interest. So you probably have three buckets here. The first bucket is these are the true evildoers. You want to stay away from them, and these are people who are just trying to make as much money from the shareholders as possible, and they don't care how they do it as long as it's legal. In some cases, maybe not. And these people, it's kind of, I don't say easy to spot, but it's easier to spot those in some ways because they're doing, they're setting terms for themselves for their compensation, for a lot of things that are very one-sided and favorable to them. And that's in that one group, the net tail. And then the kind of the fat part of the bell curve, if you will, is people who are kind of mainstream. They kind of have mediocre alignment. Maybe they own a bit of stock, but not too much. Maybe they hire the same compensation consultant that everyone else has, and they have the standard smorgasbord of different metrics. Some of them are good, some of them are bad, but they check all the boxes, and the alignment isn't particularly strong, but it's not terrible. And that's kind of, I think, where I would say the majority of management teams nowadays fit. And then you have the third group in the other tail, and these are the owner-operators or people who really have an ownership mentality, who really think about running the business as a partnership between themselves as the management team and you as the shareholder, and they're truly driving alignment through things like a very large direct ownership stake in the stock. So that's an example of a really great alignment. So if someone has the vast majority of their net worth in the stock and they're a long-term holder together with you, you have alignment. You're going to share the same financial outcome over time. So those are the ones you prefer to have. The second group, I would say they're okay. I don't eliminate them, but that's not the preferred choice. And the first group, the group that tries to make as much money off of you as possible, you just eliminate. So that's company quality. You are trying to assess the quality of the business. You're trying to assess the quality of the management. And then the third is quality of the balance sheet. In the balance sheet, what you want to do is make sure that the company can come upon a temporary time period where profits are down, where things are hard, and that's unexpected, and still survive, and not just survive, but survive in a way that doesn't dilute your ownership in the business. So for instance, let's say a company has too much debt, and then a recession hits, and if it has so much debt that let's say misses its covenants on that debt, it might have to issue equity and dilute your ownership stake in the business. So on the other side of that recession, your value per share is lower. That's a bad outcome because then you have a permanent loss because the value is lower, not just the price. So you really want to focus on balance sheets that can withstand that adversity and survive and come out without having the company be a forced raiser of capital at an inopportune time. So to recap, we have three sources of quality. I would say the most important in my mind is the business quality, and that's based upon industry quality and the competitive advantage each company has. We have the second aspect of quality, which is the management quality, and that's about competence and alignment of interest. And finally, it's the balance sheet quality, and that's about abilities to survive temporary adversity without decreasing value per share. So that's the step one. That's how we assess the quality of the company. So let's talk about step two. And step two really is about figuring out what are the key economic metrics or variables for this business, and what's the range of values for them. And let me tell you a quick story. Early in my career, I had a chance to ask Warren Buffett a question. And this was about 17 years ago at a large group dinner before the Berkshire Hathaway meeting in Omaha. And I asked him, how do you assess a company for investment? And he said, well, the first thing I try to figure out is, can I look at the key economic characteristics of the business and roughly understand what they'll be in 5 to 10 years? And if the answer is no, then I just pass. And I think that's very powerful because There are businesses where you look at them and you really can't figure out what are the key economic characteristics or the key variables. Or you figure out the variables, but you have no idea how to think about what they will be in 5 years or so. That's a good time to just pass and say it's too hard. You can look at other companies. There are many potential candidates. You don't need to do a high degree of difficulty investment. So step 2 both helps us identify whether we understand the business well enough, which has already kind of been aided by the step 1, where we assess the quality of the company. And also it helps you come up with a range of values. So for instance, let's say you're looking at a retail company, and there might be 3 key variables. It might be the number of stores that they're going to eventually open. It might be the unit economics of each store. And finally, it might be capital allocation, how they're going to finance that growth or something like that. So that's an example. And the idea here is you want to be as specific as you can. So you can be generic and say, well, it's always sales growth and margins and capital intensity or something like that. And that's true, but that's not as useful as being specific to the business and understanding what makes this business tick. What are the, no more than 5, preferably 3 things that you really want to know if you were to predict a range of future outcomes for the economic characteristics, and then come up with a range for each variable from worst case to best case, with a base case being the most likely scenario. So that's step 2, analysis of economic variables, where you're both understanding what the key variables are and you're also forecasting a range of future values for each variable. Step 3 is actually not that hard. It's financial modeling. And by this point, you've done pretty much all the heavy lifting. You've assessed the quality of the business, and you understood what the variables are, and you understood what a reasonable range of values is for the business. So here, I always like to start with the financial history. I usually collect 10 to 20 years of historical data. I try to understand both the nature of what gave rise to that history, and also what it was, so both context and the data together. And now you're trying to model the future in a range, because it's always a range. You never, for a business, can tell with precision, with pinpoint accuracy, what it's going to be. So it's a range from worst to best, with a base case being as the most likely. And I would say, kind of as a side point, sometimes people I mentor ask me, how pessimistic should the worst case be, or how optimistic should the best case be? Well, there's an art to this, so it's not a mathematical formula, but I kind of think of it as a 1 to 2 standard deviation negative event. So it's not that aliens land on Earth and take over the company's management, and or it's a fraud, or because then every time you're going to have 100% downside in your valuation. It's a reasonable worst case based on the nature of the business, which, by the way, usually implies that the better businesses have a narrower range of values in the financial modeling, and the worst businesses have a much wider range of values. So financial modeling just follows through from step 2 and actually creates a financial model for the income statement, the balance sheet, and the cash flow statement, to come up with a goal being to come up with a set of future cash flow projections for each of the 3 scenarios, for the worst case, the base case, and the best case. So that's step 3. So step 4 is valuation. And valuation, but I think sometimes people misunderstand, and I think value investing really, you have to be a valuation guru, and that's your competitive advantage, how well you do valuation. That's really not the case at all. And the reason it's not the case is that the really hard part is figuring out the business and figuring out range of future paths it can take. Once you've done that, valuation almost logically follows, right? You have your stream of cash flows for each scenario. Now you have to value them. So there's 2 general approaches, right? There is a DCF approach, so discounted cash flow model, where you're taking the net present value of those cash flows, plus adding in any excess assets that are not used to generate that net present value of cash flows. And then there is various multiples approaches that people use. And so let me give you kind of both the pros and the cons of each, and then tell you how I do it. So people always say the big criticism with the DCF model is that you can make the model spit out anything you want. It's kind of garbage in, garbage out. And I think that's fair, but I would say that, well, it's kind of like saying that you can hit your finger with a hammer if you try to hammer in a nail. That's true, but it's still a better tool for hammering in a nail than a screwdriver might be. So you kind of want to use the right tool, and I think the DCF, as long as you don't make it too complicated, and you have a reasonably good sense of how to come up with that range of cash flows that we talked about in steps 1 through 3, it's still the best tool. But I think you can supplement it with various multiples. So when I say multiples, so an example might be a price to earnings multiple, and in this case, by earnings, I try to use normalized earnings adjusted for where we are in the economic cycle to bring us back to a mid-cycle level, and also to normalize for any one-time items that might be distorting earnings up or down, say like one-time gains or one-time charges that are not truly non-recurring. So that's another good sanity check. Another way to think about it is look at what's happening in the private market. So what are the valuation multiples at which companies are buying similar companies? That doesn't mean that they're right, because sometimes companies buy companies at one valuation level and then a few years later they take a big write-down, which essentially means, oops, we paid too much. So you don't want to take, kind of historical transaction multiples as some truth, but it's another check of what arm's length buyers who are doing deep due diligence on similar businesses, what are the conclusions they're coming to. So you triangulate between all of those approaches. You have your DCF approach, where I use a DCF of equity cash flows with a 10% discount rate, where the discount rate is meant to represent your long-term opportunity cost. And then I cross-check that with multiples like price to earnings, like transaction multiples in the private market and so forth. So that's step 4, that's valuation. Remember, the goal is to come up with a range of intrinsic values from worst case value to best case value, with the base case being that most likely value for the business. So finally, we come to step 5, and step 5 is very important. So I'm a big believer that behavioral biases is one of the biggest roadblocks that most investors face. We're all overconfident. Well, maybe not me. I'm just kidding. We're all overconfident in some ways. We anchor. We have confirmation bias, where we look for, more for confirming evidence versus disconfirming evidence. And it's important to be aware of it. And I think awareness is a first step. It's not enough. You need to have a systematic, active defense against these biases, both to help you make better decisions, but also to create the rigor so you can actually stay rational and stick to the decisions that you're making under pressure of real-world conditions. As Mike Tyson famously said, everyone has a plan until they get punched in the mouth. And that's a boxing metaphor, but I think it applies here as well. It's important to have not just a theoretical process, but a way to keep to it when the going gets tough. So some things you can do, you can track your thesis. I have something I call the thesis tracker, where every quarter I, as objectively as possible, categorize new information as favorable relative to my long-term expectations or unfavorable, and I literally color code the grid so I can see, is this company flashing red or is it flashing green, and that causes me to take certain actions. So if it's a certain number of time periods where the company is deviating unfavorably from my expectations, I might start from scratch to try to get rid of that anchoring bias and revalue it completely again. And that's one example. I also have something what I call the Devil's Advocate Club, where I've put together a small group of other experienced value investors where we help each other debias one another by presenting a strong alternative point of view on the companies at each person's request with real work and a strong kind of argument on the opposite side. So that's another way of making sure that rather than looking for confirming evidence, that you are seeking out strong opposing points of view. So, and sometimes you want to kind of make sure you customize the list to a situation or to your own strengths and weaknesses. I teach a course to graduate school students on value investing, and one of the things I always highlight is the importance of having a customized process that's customized to your strengths and weaknesses, not just something that's generic out there. So that's the 5-step research process. Just to recap, the 5 steps are company quality assessment, followed by its analysis of key economic variables, followed by step 3, which is financial modeling, step 4, which is valuation, and finally step 5, which is behavioral checklist.